Okay, let's unpack this. Imagine your car loan, your credit card debt, maybe even a local business's line of credit, suddenly becoming the fuel for global investment funds. It sounds almost like, well, financial alchemy, right?
It does a bit, yeah.
That's the sort of counterintuitive power of securitization. It's
Yeah.
a process designed to unlock capital, create massive liquidity.
Uh-huh.
But, and this is the big but, one that has also famously masked systemic risks.
Hmm. A definite double-edged sword.
So today, we're diving deep into this pretty fascinating corner of finance. Our mission really is to demystify securitization for you. We'll explore what it actually is,
Yeah.
follow a loan's journey step by step through the whole thing, uncover the different forms it takes, and crucially, dissect both its, incredible advantages and its darker side.
Including its infamous role in a past financial crisis. We have to talk about that.
Absolutely. By the end of this deep dive, you'll have a powerful shortcut, hopefully, to being well-informed about this critical financial instrument.
What's truly fascinating here is how securitization acts as, well, a cornerstone of modern finance. It enables tremendous capital flow, market liquidity.
Right.
But like any incredibly powerful tool, understanding its profound nuances, both its strengths and its potential pitfalls, is absolutely essential.
So we'll try and connect the dots for you today.
Exactly.
Right.
From that individual loan you might have,
Yeah.
all the way to its, broader market implications.
So let's start at the very beginning. At its heart, what exactly is securitization? It sounds complex. Can we sort of boil it down?
Absolutely.
Okay.
Let's try. Think of it this way. Imagine you own, say, a collection of rare, high-value vintage cars.
Okay. Nice collection.
Right. Individually, they're not easy to sell quickly. They're what we call illiquid.
Hard to turn into cash fast.
Exactly.
Right.
But if you could bundle that entire collection, maybe create shares of ownership in that bundle, and then sell those shares to lots of investors, suddenly you've transformed those hard-to-sell cars into easily tradable financial instruments.
Oh, okay. I see the analogy.
That's essentially what securitization does with loans. It takes something that's not easily tradable, like your individual mortgage, pools it with similar assets, and then repackages those pools into interest-bearing securities that investors can buy and sell.
So it's about transforming illiquid assets like loans into something liquid and tradable. That's a really powerful idea.
It is.
And you mentioned those interest-bearing securities. What are the core components that make these up? What types of debt are we usually talking about here?
Yeah, the key takeaway is indeed that transformation. Assets that are traditionally illiquid get merged into marketable financial instruments. Now, while securitization, broadly speaking, can apply to things like, Bitcoin or Ether for crypto ETFs or properties for REITs,
Right, other asset types.
our focus for investors and regulators is usually specific financial assets. Think mortgage loans, consumer debt like credit cards or auto loans, and commercial debt.
Okay.
So when we talk about these instruments, we're looking at a few core things. First, securitization pools or groups these debts into portfolios.
Grouping them up.
Then, issuers create marketable financial instruments by merging these financial assets into tranches. We'll definitely get into tranches later.
Okay.
These instruments then provide investors with income. That comes from the interest and principal payments from those underlying loans. And we typically see this in two main categories you'll hear about. There's MBS, mortgage-backed securities.
Yeah, by home loans. Makes sense.
Exactly. And then there are ABS, asset-backed securities. That's more of a general term for securities backed by non-mortgage assets.
Like what?
Like auto loans, mobile home loans, credit card loans, student loans, that kind of thing.
Got it. So MBS for mortgages, ABS for pretty much everything else debt-wise. The idea of pooling debt into tranches is already, intriguing. But how does this financial alchemy actually happen? Let's peek under the hood, follow the full journey of loan through this. It sounds like a complex dance.
It is. It's quite a sophisticated multi-step process. Maybe we can trace it through, say, 3 key phases.
Okay, let's do that. Where does it start?
It starts with how a loan even begins its journey into this world. Let's call phase 1 origination and pooling. We begin with asset origination. That's just where a lender, think your local bank, issues loans.
Mortgages, auto loans, credit cards.
Right, exactly. Business lines of credit, too. These are the basic raw materials.
So just regular loans being made every single day. Then what happens?
Exactly. Next, these individual loans, they aren't just tossed together randomly. They're meticulously organized into asset pools.
Okay. How are they organized?
They're grouped by similar characteristics. Things like the type of loan, the maturity date, and, this is critical, the credit quality of the borrowers. This carefully constructed pool then serves as the collateral for the securities that are going to be created later.
Ah, so the pool itself backs the investment.
Precisely. It's all about creating a somewhat predictable stream of payments from a diverse set of borrowers within that pool.
That makes sense. Grouping similar risks together. Now, this is where it gets into the real financial engineering part, right? What's the next phase in this journey?
You got it. We move into phase 2, structuring and isolation. This is where the legal and financial architecture really takes shape.
Okay.
And this is where some of the most critical elements for both efficiency and, importantly, risk management are put in place. A crucial player emerges here, the Special Purpose Vehicle, SPV, sometimes called a Special Purpose Entity, or SPE.
SBV. Okay, what does that do?
Think of it as a separate legal entity. Its unique design is to be bankruptcy remote.
Bankruptcy remote, meaning?
Meaning it's like a financial fortress or maybe a legal shield. This design deliberately detaches the pooled assets from the original lender's balance sheet.
Yeah.
It shields them from the original lender's financial troubles.
Right.
So if the bank that made the loan goes, belly up,
Right.
your investment in the securities backed by those loans is theoretically supposed to remain secure.
So that SPV is like a massive firewall. The bank makes the loan, but then legally hands it off. How does that transfer actually work?
Good question. The lender then formally transfers the assets, those proved loans, to the SPV. This move takes the assets right off the lender's balance sheet.
Which frees up their capital, right?
Exactly. It often frees up capital for the bank, allowing them to underwrite even more loans. It's a key step in creating that liquidity we mentioned earlier.
Okay, so the loans are now legally separate inside the SPV. Then what?
Then comes tranching. This is where the SPV divides that loan pool into different risk classes.
The slices you mentioned.
Yeah, the slices. Typically, you see senior, mezzanine, and junior tranches. The junior is sometimes called the equity tranche.
Okay, senior, mezzanine, junior. What's the difference?
Each tranche has a different risk and return profile. Senior tranches get paid first from the loan payments coming in, so they're less risky and naturally offer lower returns.
Safest bet.
Kind of, yeah. Junior tranches are paid last, only after the senior and mezzanine tranches are fully paid. So they carry higher risk, but they offer the potential for higher returns.
Higher risk, higher potential reward.
Exactly. And this tranching structure allows the issuer to attract different types of investors, based on their appetite for risk.
So it's like slicing a pie into different pieces, each with a different level of sweetness and I guess a different price tag reflecting that risk.
That's a good way to think about it.
And to make these slices even more appealing, you mentioned something earlier called credit enhancement. What does that involve?
Right. So to make the securities more attractive to investors, and often to achieve higher credit ratings from the agencies, credit enhancement techniques are used.
How do they enhance it?
Well, a really common one is over-collateralization.
Over-collateralization.
Yeah, think of it like putting, say, $110 worth of loans into the pool to back only $100 worth of securities being issued.
Ah, so there's extra collateral.
Exactly. That extra $10 acts like a built-in safety cushion. It's there to absorb the first losses if some borrowers default, before those losses start impacting the investors, especially the senior ones.
Clever, like a buffer zone.
Precisely. Other enhancements might include things like reserve accounts, basically cash set aside, or even guarantees from third parties sometimes.
That's a smart way to build in a safety net. So, okay, we have the loans, they're pooled, legally separated in the SPV, structured into these different risk layers called tranches, and then boosted with enhancements. What's the final phase?
The final phase is all about market and management. This is bringing these newly created instruments to the investors and then ensuring their ongoing performance is tracked.
Getting them sold and keeping track.
Right. So this phase usually begins with rating. Independent credit rating agencies, like Moody's or S&P, they assess the creditworthiness of each individual tranche.
Okay.
They assign ratings based on the perceived risk. And as you might expect, the senior tranches typically receive the highest ratings, reflecting their lower risk profile due to that payment priority and enhancements.
And those ratings are obviously crucial for investors. It gives them a quick snapshot of the risk involved.
Absolutely critical. Once they're rated, the securities are marketed and sold to investors. This is usually done through investment banks.
And investors choose based on risk.
Yeah, investors choose which tranches to buy based on their own risk tolerance and their investment objectives. Pension funds might want the safer senior tranches. Hedge funds won't go for the riskier junior ones.
Makes sense. Then the money starts flowing.
Hopefully. As borrowers, the original homeowners or car buyers diligently make payments on those underlying loans.
Mm.
That cash flow is collected, usually by a third-party servicer, and then distributed to the investors who bought the securities.
And distributed according to the tranches.
Critically, yes.
Mm.
Senior tranches get priority in receiving those payments. Then the mezzanine, and finally, if there's enough cash flow left, the junior tranches get paid.
So the payment waterfall, as they sometimes call it?
Exactly, the waterfall structure. And finally, there's ongoing monitoring and reporting. This is supposed to ensure transparency.
It's supposed to.
Well, yes. It provides performance updates throughout the life of the securities, allowing investors to track how their investments are doing, and, in theory, ensuring accountability.
Okay. That whole process. Wow.
It is intricate.
Yeah.
But if we connect this back to the bigger picture, this entire process, when it works well, frees up capital for the original lenders.
Right, letting them make more loans.
Exactly. Which can stimulate economic activity. And it profoundly promotes liquidity in the marketplace by making these loans tradable.
That's a truly detailed breakdown, thanks. It really shows the immense engineering involved. But you mentioned not all securitized products are created equal. We heard MBS and ABS, but within that world, are there different structural forms they take?
Indeed, there are. There are a few main types, and each has its own structure, its own characteristics. It really impacts how the cash flows are managed and how the risk is distributed.
Okay, what are the main types?
Well, most basic is probably pass-through securitization.
Pass through. Sounds simple.
It is, relatively. Here, the cash flows from the underlying assets, say mortgage payments, are simply passed directly through to the investors. The SPV issues what are called pass-through certificates. These represent an undivided interest, like a direct share, in the pool. And importantly, no tranches are involved here.
Ah, no slicing and dicing.
Nope. MBS from the government-sponsored enterprises, the GSEs, like Fannie Mae and Freddie Mac, those are classic examples of this straightforward structure. You own a proportional share of the pool, you get a proportional share of the payments coming in. Simple, direct.
Okay, so with a pass-through, you're basically getting a direct slice of the original loan payments. What happens when it gets more complex?
Right. Then we move to things like pay-through debt instruments. These are often referred to as collateralized mortgage obligations, or CMOs.
CMOs, okay, how are they different?
These are where things become more sophisticated. The cash flows from the underlying assets are still used to pay investors, but the securities are structured as debt obligations of the SPV.
Debt, not just certificates of ownership.
Exactly. And crucially, they are divided into tranches with different maturities, different risk profiles, different payment priorities, that waterfall structure we talked about.
Ah, so CMOs use tranching.
Yes. So it's not just a simple pass-through. The cash flows are actively managed and redistributed according to those tranche rules.
Okay. And the third type?
Finally, and, well, notoriously, we have collateralized debt obligations, CDOs.
CDOs, the name definitely rings a bell from recent history.
It certainly does. CDOs involve pooling a really diverse range of debt obligations. This could be corporate bonds, various types of loans, or even other securitized products like MBS or ABS.
Wait, so a CDO could own pieces of MBS?
Yes. And that's where the complexity starts to explode. They're also divided into tranches, just like CMOs, each with its own risk and return characteristics.
Now, this is where the story takes a bit of a dark turn, isn't it? CDOs, especially certain variations, played a, well, significant and infamous role in the 2007-2008 global financial crisis. What made them so problematic?
You're absolutely right. This is where it gets critically important to understand. CDOs, particularly things called CDO squared and even CDO cubed.
Squared and cubed, like CDOs owning other CDOs.
Exactly. They were essentially backed by other CDOs, which were themselves backed by other assets, often including those subprime MBS. It became like financial matryoshka dolls, one layer inside another and inside another.
Wow.
The core insight here isn't just that CDOs were complex, though they were incredibly complex. It was that this layering of debt upon debt created such an opaque structure.
Opaque meaning hard to see inside.
Extremely hard. Even the brightest financial minds struggle to truly understand the actual risk buried deep inside these structures. It was like a house of cards built on a foundation of hidden, interconnected uncertainty.
Because you didn't know what was really at the bottom layer.
Precisely. Many were backed by those subprime mortgages we heard so much about. And because of the immense complexity and the, frankly, lack of transparency, it became incredibly difficult, almost impossible, for investors to assess the underlying risks.
So when things went bad?
When the U.S. housing market started to collapse and those subprime borrowers defaulted, it triggered massive losses throughout these layered CDO structures. This led to a widespread, almost total loss of confidence in the securitized product market. The ripple effect was catastrophic because nobody truly knew what toxic assets they owned or what their counterparty owned.
That analogy of financial matryoshka dolls, it really captures that escalating complexity and the just loss of transparency. Scary stuff. So what does this all mean for us? Like most powerful financial tools, securitization isn't just bad, right? It has upsides, but clearly comes with significant potential pitfalls.
Indeed, it's crucial to see both sides. On the advantage side, let's not forget securitization turns illiquid assets into liquid ones. That is a huge
It's
benefit.
capital?
Yes, it frees up capital for the originators, the banks, to make more loans, which can foster economic growth. It also provides new, often diversified income streams for investors.
And access for smaller players.
Exactly. It allows even smaller investors to participate in markets, like the mortgage market, that they otherwise couldn't easily access. And it's also worth noting, many loan-based securities are backed by actual collateral, the houses, the cars, which adds a layer of security compared to, say, unsecured corporate bonds.
It sounds incredibly efficient on paper. A win-win.
Okay.
Freeing up capital, offering new investments. But critics often point to a kind of moral hazard here. Like, originators might become less concerned about the quality of the loans if they know they're just going to sell them off quickly. Is that a fair concern?
That's a very fair and absolutely critical concern. It highlights one of the most significant disadvantages. When lenders know they can quickly sell off the loans, it can indeed reduce their incentive to thoroughly vet borrowers. This is sometimes called the originate-to-distribute model, as opposed to originate-to-hold.
Originate to distribute, yeah.
The risk is passed on. So investors, in turn, effectively assume the role of the creditor, taking on the risk that the underlying loans might default.
But without knowing the borrower personally?
Exactly. Often without the direct knowledge or detailed information about the original loan quality that the originator had or should have had. And as the crisis showed, there can be a serious, systemic lack of transparency regarding the actual assets packed inside these securities. Those misrepresented MBS and CDOs were prime examples.
Right.
And for individual investors, another risk we should mention is prepayment risk.
Prepayment. People paying back too early. Why is that a risk?
Well, it's a risk to your expected return. If borrowers refinance, maybe because interest rates fall or just pay off their loans earlier than scheduled, that alters the anticipated cash flow stream you're expecting from your investment. It can cut your overall returns because you get your principal back sooner and have to reinvest it, potentially at lower rates.
Okay. So transparency and prepayment risk are big potential downsides, alongside that originate to distribute issue. To really bring this home, maybe let's look at a concrete everyday example. What about mortgage-backed securities, say, offered by a big brokerage like Fidelity? Specifically, the ones issued by those government-sponsored enterprises. How does that work for a regular investor?
Great example. When you buy an agency MBS, as they're called, from a broker like Fidelity, you're investing in a pool of mortgages that are guaranteed by U.S. government-sponsored enterprises, the GSEs.
The agencies we mentioned before.
Exactly. These primarily include Ginnie Mae, that's the Government National Mortgage Association. Ginnie Mae guarantees the timely payment of principal and interest on MBS that are backed by government-insured loans like FHA or VA loans. Importantly, Ginnie Mae itself doesn't buy, package, or sell mortgages. It just provides the guarantee on securities backed by those specific types of loans.
Okay, so Ginnie Mae is the guarantor.
Then you have Fannie Mae, the Federal National Mortgage Association. Fannie Mae does purchase mortgages from lenders, packages them into bonds, MBS, and then guarantees and resells them to investors. It basically creates a huge secondary market for mortgages.
Got it. Buys, packages, guarantees, sells.
And finally, Freddie Mac, the Federal Home Loan Mortgage Corporation. Very similar to Fannie Mae. It also purchases mortgages, packages them, guarantees them, and resells them, all to provide liquidity to the housing finance market.
So Fannie and Freddie are the big players in actually creating these agency MBS. Now, when a homeowner makes their monthly mortgage payment on one of those underlying loans, what happens to that money from an investor's perspective who holds the MBS?
Right. So as homeowners make those monthly payments, principal and interest, the cash flows are collected by these agencies, Fannie or Freddie, or processed for Ginnie Mae guaranteed pools. Then that money is distributed pro rata to the investors holding the MBS. This means proportionally. If you own, say, 1% of a particular MBS pool, you get 1% of the principal and interest payments that come in from the homeowners in that pool that month. It's pretty low.
Okay. So investors get regular cash flows.
Yes, regular cash flows and potentially some capital appreciation if interest rates fall and the value of their bond goes up. However, they do still face that prepayment risk we talked about.
Because homeowners might refinance or sell their house early.
Exactly. If rates drop, lots of people refinance, and you get your principal back faster than expected, which changes your yield.
But the big difference here is the guarantee.
That's the crucial point for agency MBS.
Hmm.
They were backed by the full faith and credit of the U.S. government, either directly like Ginnie Mae or implicitly like Fannie and Freddie after the crisis bailouts.
Okay.
This makes them considered among the safest fixed-income investments available. Very different from the non-agency or private label MBS, which don't have that government guarantee. Those carry much higher credit risk and are a much smaller slice of the market today than they were before 2008.
That distinction is key. Agency versus non-agency.
Absolutely. And just to quickly clarify once more, MBS are specifically backed by home loans. ABS are backed by those other non-mortgage assets, auto loans, credit cards, student loans, and so on.
Got it. Now, with all this complexity, these massive instruments shaping our economy, who actually keeps an eye on this vast market? Who's regulating it all, especially after the crisis?
Yeah, good question. In the U.S., companies that are involved in securities or investment activities, the banks, the brokers, the issuers, are primarily regulated by two key bodies. There's the U.S. Securities and Exchange Commission, SEC. Their job is to protect investors and maintain fair, orderly, and efficient markets. They set rules about disclosure and try to prevent fraud.
The SEC, okay.
And there's the Financial Industry Regulatory Authority, FINRA. FINRA is actually a self-regulatory organization overseen by the SEC, but it directly regulates brokerage firms and exchange markets. They handle licensing, trading practices, and enforcement for their member firms.
So the SEC and FINRA are the main watchdogs.
They are the primary regulators in the U.S. security space.
Mm.
Their oversight is critical in trying to ensure market integrity and hopefully prevent the kinds of systemic issues we saw unfold in the past.
We have covered a tremendous amount of ground today, really peeling back the layers on securitization. It's quite something. We've seen how it takes individual debts, bundles them up, and transforms them into these marketable financial instruments that generate income for investors.
Mm-hmm.
We've followed a loan's journey through those intricate three phases: origination and pooling, structuring and isolation, market and management.
Right.
Explored the different types, from the simple pass-throughs to the profoundly complex and, yeah, sometimes problematic CDOs.
Definitely.
And we weighed its significant advantages, liquidity, capital creation, against those serious risks, like the lack of transparency and that ever-present prepayment risk.
I think if we connect this all back to the bigger picture, truly understanding securitization helps you grasp how seemingly small individual loans, your mortgage, your neighbor's car loan, can be aggregated and transformed into these complex instruments that have a genuine global financial impact.
It's staggering, really.
It is. It's a powerful mechanism for liquidity and capital in our modern economy. But as we saw, it's also a stark reminder of how absolutely critical transparency, responsible structuring, and frankly robust oversight are to prevent systemic instability.
Yeah.
This deep dive, I hope, reveals just how deeply interconnected our financial world really is.
Absolutely. So for you listening, the next time you hear about a mortgage-backed security or an asset-backed security, hopefully you'll know exactly what's behind it. You'll be able to see beyond just the surface label. Understand the sophisticated, sometimes dizzying mechanisms that drive so much of our economy, and maybe even, question the assumptions behind some of these instruments. What stands out to you from this discussion? How does something so complex underpin so much of our daily lives? And maybe what questions does it raise for you about the future of finance?